Have sound in 2 rooms as well as screens. Awesome, thank you. Thank you so much. Hello again. All right, so Henry and I are going to be walking through the run into earnings. This is going to be one of our favorite setups that we like to do every quarter. We've really been able to hone this over the years, narrow it down to the different types of tickers that we like to look at, go over our overall process, how we get in and out, and whatnot. So this is what we're going to be explaining to you here today. So first of all, I'm going to go through the overall presentation that is an outline of the trading strategy. We'll do some old examples, and then Henry's going to do some current trades. So HG, you can jump in whenever you want, and I'm going to go ahead and start going through the presentation. All right, so taking advantage of market opportunities. Trading, I mean, really, it's all about opportunities and recognizing moments in time where we have an edge. And the run into earnings season is one of my favorite edges that we have, but it's all about timing it properly. So whenever we're looking at the various companies that we like to trade and the various earnings reports, it comes down to dividing these into 3 phases, okay? Because we can look at any stock, right, and we can see where the report is on our Thinkorswim. But this gives us 3 distinct trading ideas, and the first one is the one that we're going to be covering today. The first piece of that is going to be the run into earnings. It's going to be the time period before the earnings report, and within that, we're really only trading the time period before the earnings report. We're not trading the actual report. We're just trading the run into earnings. The second phase of earnings opportunities is obviously going to be trading the actual report. We do that in the room as well. But this is going to be lower probability than both the run into earnings and the after earnings plays, but we still like to throw those on when we deem it a good moment in time. The third phase here is going to be the after earnings play. So that is another one that we like to do. We like to call it, especially the 2X move is a favorite of mine. But today we're just going to be focusing on the run into earnings. So which stocks do we like to focus on? Typically like to focus on strong stocks with a bullish sentiment. Why? Because those are the stocks that people are buying ahead of those earnings reports. So it's all about that sentiment going into that report. Why are we looking at it today? So this slide is showing the next earnings quarter, but at the end of the day, it's just about the overall concept, right? Because there's periods of time where you have a lot of earnings reports. So you really need to start focusing on your run into earnings about 2 to 3 weeks before peak earnings season to get all of your trades on. We typically like to start that about 2 weeks before Amazon, Microsoft, and the like start to report, which are reporting at the end of this month. The basic concept here is really we're just focusing on trading both price and implied volatility higher. Why? Because during the run into earnings, you have both price and implied volatility rising going into the actual earnings report. So of course, you need the stock to move directionally to have price rising. But in a lot of instances, even if the stock is pretty flat, you are still going to get a rise in implied volatility going into that earnings report. It reaches peak IV directly before the earnings report, and that's what we're really trying to capitalize on. We're trying to buy it here while it trades higher, sell it here before the actual announcement to take advantage of that rise in IV. So here are a couple examples. And it'll change. We have some companies that we like to do every quarter, and it'll change a little bit just depending on, what industries are strong or what stocks are hot. But overall, if you go through and you look at a daily chart and you look at the past about 8 quarters is typically what I like to look at, you can see the price run going into earnings. Now, this one in this example is Micron. You can see that some of the runs into earnings lasted a little bit longer than others, and that's why we use a couple different tools to time that. But at the end of the day, I mean, really what you're trying to capture is the space between about 7 and 21 days or so prior to that earnings report. You can also see on this graph down at the bottom implied volatility, and you can see how the IV rises. With that rise in IV, you're getting a rise in your options price that also helps you make money. So here's another example, Google, and this chart is from last year, I believe, but we're going to go over some live examples after the fact, and Google is actually one of the examples that Henry is going to go over. But this is one that has been pretty consistent for the run into earnings on a pretty regular basis. So that's another one that we really like to trade. So what is the setup actually? Well, the setup is a combination of a bunch of different factors. Number one, we're combining the initial market observations. So the entire setup comes from the idea that companies trade higher going into their earnings report because there's that bullish sentiment behind them, okay? So that's your initial observation, but you have to really break that down and you have to turn that into a trade. What's number two? This is really critical, and it's something that Henry's been able to do really well, is really narrow down which stocks we want to focus on. For the most part, we like to focus on a lot of tech stocks, but really anything with that positive momentum behind it will do. Number three, we really like to combine our technical work combined with fib analysis. So we look at the voodoo lines, we like Fibonacci, of course, and then we also use the moving averages and we're looking for confluence. Number four, something that's very important to us, is going to be a solid entry point. So what is that? We always like to enter on a pullback. We do not like to buy the highs. We don't want to buy something after it's rallied for a while. We really always try to enter on a pullback. If that's not possible, you can always get a little piece of it and then add more as it pulls back. So the fifth piece of this is the option setup, which we're going to talk a little bit more about, but you do want to identify option setups that are going to help you really capitalize on the run. And primarily, a lot of the times we just use long calls because you really want to get that IV increase as well. And a lot of the times, I mean, if you're selling a spread or something, it's just not going to come through how you want it to come through. All right, so what does a solid run into earnings contain? We already went over most of this, but this is just a really good summary slide. You got to have the overall idea. You want to have a setup that's technical in nature, mixed with a little bit of fundamentals. We really do prefer to have a trend. In this market environment that we're in, we don't have as solid of trends as we used to have previously, but we do prefer trending stocks for the setup. The next part is going to be the support and resistance. Got to have a good area to get in. And B, you're asking about the squeeze. So do we use the squeeze? Yes, we definitely do use the squeeze, and we're going to talk about that a little bit more, but we like to align the squeeze with the timing for the run into earnings. Next part, that entry point, we want to time that. We want to time it when we have a low IV to really capture the vol pop. The last piece of that is the fundamentally strong techie name. So especially anything, I mean, just think about it. What industries are hot right now? The cloud, cloud. Tech isn't as hot as it has been this quarter, but that doesn't mean that some of these companies that are very much so in the limelight aren't going to still have a really good run into earnings. So we like the tech names, and we're going to look at a couple others as well. But it really just boils down to the stock selection and then the overall timing. Danielle, Henry, the CML trade machine for researching earnings analytics includes alerts. Yes, that's definitely correct. And we'll get into CML a little bit more as well. But yes, CML is a really important part of the setup. Can you explain the IV crush and about how far do you set up your options? Yes, I'm going to talk about the options a little bit deeper into the presentation. But basically the way that it goes is implied volatility rises and rises and rises going into an uncertain event, which is earnings. Okay. It goes up and goes up because there's going to be volatility based on the earnings report. So the IV goes up, making the price of the option higher. And then once that uncertain event is over, that IV gets sucked out of those options, and the price of that option will then be less after that earnings report is over. So what we're trying to do is we're trying to come in earlier because we know that that's how options pricing works. And we want to buy it down here and sell it up here. And yes, we can talk about Apple. Historically, I haven't found that Apple is a great one for the run into earnings because Apple has always had a lot of negative news surrounding the speculation over the amount of iPhone sales. I have found Microsoft, Amazon, Google to be a lot better when you're looking at the FANG stocks, especially Netflix too. So when we're looking at a chart, how do we quantify the trend? Well, you want to look for a pattern of higher highs and higher lows. You're looking for an overall stair step. What about steady retracements? So steady retracements is something that's really important in the context of higher highs and higher lows. You don't want higher highs, boom, and then like death, like Johnson & Johnson. That's not a steady retracement. That's a violent pullback. For a solid trend, you want a pattern of higher highs, higher lows, like a stair step. You also want steady retracements. We also will talk about this in a way that it maintains symmetry. Okay, what does maintaining symmetry mean? Well, maintaining symmetry really just means that the pullbacks are about equal. Okay, you want to see it in a nice symmetrical fashion. Where is price going to be? Well, you want to see price in relation to the moving averages. You want to see price on top of the moving averages, telling you that you're in a strong trend. Prefer to see it above the 34 EMA, especially with the way that the market is right now. I've lowered that, and the 50, 50 is going to have to work for right now. When we're in a stronger bullish trend, then we'll use the 8 and the 21 EMAs as a little bit tighter hold. And then to see a really nice strong trend, we also like to see stacked moving averages. This is a bonus that we aren't really going to get that much in this overall market condition, but if we do go back to a nice bullish trend, keep in mind if the stock is near lifetime highs, that is a great bonus to have. So next part, chart technicals. We always want to look at an anchor chart. So we primarily do our analysis on the daily charts, but we also like to look at the weekly charts. Henry likes to use the weekly chart with the 10 simple and the 34 exponential period moving averages. And why do we do this? We want to see a chart that has the wind at its back. Okay, Fibonacci is also a really nice component. If we have a chart in buy mode on the weekly chart with a 10 simple, 34 exponential, and we have price above that in a good enough trend, then we consider that a pretty good shot to look at for the run into earnings, especially if it's coupled with Fibonacci, especially if it has a squeeze, and especially if it has a history of it working for the run into earnings. So for example, part of XLF, see where the moving average is crossed right about here. You can see that price is staying above that 34 EMA on the weekly chart. It comes down, it holds those levels, and it maintains that 34 EMA. You can also see that the 8 is above the 34. So that's pretty much what we're looking for there on the weekly chart for an anchor. On the 8 and 21 EMAs, what time frame are you using? The daily chart. This one is a weekly chart. And then on the daily chart, I'm using the 8, 21, 34 EMAs. And then the 50, 100, and 200 SMAs. How many days ahead of earnings are you looking to enter a pre-earnings trade? Does it depend on the stock? Yes. So typically anywhere between like 7 and 21 days. We'll get into the actual option setup here in a couple slides. All right, so technical setup, part 2, support and resistance levels. We like to use a combination of fib. Is the chart pulling back and maintaining symmetry? Is it trading at a pullback zone versus near extensions? You always want to be buying things on the dip. You don't want to be buying them when they're extended. Is there a solid fib cluster that we can buy against, or is there a voodoo line? We really just want to make sure that we're focusing on pullback buy entries to give us an edge so that we don't have that much at risk. The next part of this that's really helpful is a squeeze. So this is kind of where we're getting into more of the specifics here. But having a squeeze in combination with the overall idea is just, it's incredibly helpful. There are definitely times, and especially in this particular quarter and in this market environment, where you don't have as many squeezes just because of the volatility that we've been seeing. But especially if we have one of our favorite stocks with a squeeze going into the run into earnings, I mean, that's absolute favorite cash money setup of mine. So what is the setup? For a longer term run into earnings, 23 to 30 days, we like to see a squeeze on the daily chart or a 195-minute chart. So, I mean, you're looking at your daily charts. You can look through the earnings calendar, look through your daily charts, and make a list of stocks that are reporting earnings in the next 6 weeks and start to pay attention in that time frame. And then look for a potential daily chart with a squeeze or a 195-minute chart. There are others that have a better run into earnings 6 to 14 days in advance. And we'll talk a little bit more about those, but some of my favorites are Alibaba, Adobe, Microsoft. So how do we time these? Usually CML. So CML Viz is very, very helpful in determining what timing is better. But at the end of the day, I mean, what we're looking for are pullbacks against support. So some of them happen 14 days in advance and some of them happen 30 days in advance. You just have to be on your game. So if it's a shorter, if we have, for example, Microsoft earnings report and it's 6 days out. Let's say it's 6 days out until Microsoft earnings report. and we see a 78-minute squeeze. It's like, all right, perfect. You know, you have a lower time frame squeeze, earnings is coming up really soon. That's a good opportunity. Does that all make sense? Thank you so much. So entry point and time frame, identifying low IV percentile, the rule of thirds. So we do have this available to members on our site. It's an IV percentile indicator. It shows basically, I don't know, Henry, you're better explaining this than I am, but basically the IV, it can only get so high, right? So what we're doing is we're looking to buy the IV when it's low and sell it when it's high. So if you're looking at IV as a percentage, it can only go up to 100%, right? So if it's at 20%, it still has quite a ways to trade higher versus lower, okay? So conversely, if you see that and it's already at like 80%, then you might be at your top range of your IV and you won't be able to benefit as much from the rise in IV because it's already really high. So that's another factor that we like to use in Confluence with this setup. So technical setup, part 4, timing tools, CML Viz. Like I was saying, for those of you who aren't familiar with it, this is a separate service that we use. It's cmlviz.com. This is what it looks like. Basically, it's all about math. All about probabilities. You can come in here and you can say, okay, well, I want to look in the NASDAQ for stocks where I want to buy long straddles, and you can't see it, but it's down here for the run into earnings. And then it will come up with this screen that says, okay, well, here's some good ones. Intuit, Microsoft, Google, and it tells you what your average rate of return is, how you time it. And so that's another factor that we like to use, but we always combine it with our technicals. Yes, I saw that there as well. And so another part that we do like to use as well is Chaikin Analytics. And this one just helps us look at an overall fundamental backing, okay? Because the reason why people are coming in buying these stocks before earnings is because they think that they're going to perform well on earnings, right? You don't want to buy something for the run into earnings if you think the thing is going to die on earnings. So if you have another way to filter a fundamental background, you know, we also really like Investors Business Daily, but we like Chaikin as well. So coming in here and saying, okay, well, what sectors or what stocks are strong? Okay, great. Let's focus on those and see if we can time that. I know, it's a lot of information, right? So sorry, I'm just reading some of the comments. I know it's a lot of information for sure, but really you got to, and this is literally like, we could make an entire 4 to 5 hour class out of this. And so trying to put it in 1 hour is quite a lot. But the idea here is that we're coming out and we're saying, hey guys, this is what we're doing in the trading room. And this is what we are going to be doing in the trading room for probably the next 4 weeks, at least 4 or 5 weeks. So what we're trying to say is, hey, this is the outline of the strategy that we're using. I mean, you're probably not going to be able to take everything in from this 1 hour, but if you have the overall idea and outline of what we're doing, then when you're coming into our trading room session, you can say, oh, okay, got it. Run into earnings, that's what I'm looking for. So that is the goal here. All right. So for the solid run into earnings, we like to focus on the stronger sectors and then focus on the top holdings within those sectors. And that is, pretty much the 5-star that I've come up with as well, and kind of combining those two things. All right, so what are the 5 components of a successful trade? Bullish trending stock. We'll forgive some of these for not being a perfect trend in 2019, and I'll put a little sad face because I love the trend, but that's what we got. Directional calls, either in the money or out of the money, 3 or 4 weeks or the week before. Henry likes to take the trades without taking a stop, risking the debit paid. I have actually gone more towards this way of doing it, just because, I mean, how many times do you get out right at 50% and then it goes the direction you wanted? And then we always like to look at Fibonacci extensions for profit targets, but we always get out of the trade before the earnings report, okay? Because we don't want to be holding through the earnings report because of the vol crush. HG, if you want to add anything, go for it. I'm going to pass it over to Henry in a bit to go over the new setups. So, how to trade it. For longer term, generally about 23 to 30 days, we like the Delta 70s. Why? Because there's more time before the earnings report, and when you're buying something that's in the money, it's going to hold its value a lot better than buying something out of the money. So you always have a choice. It's like, all right, well, do I want something that's in the money? Do I want something that's in the money where it's going to hold its value better, and on a percentage basis, sorry, this is supposed to be percentage, on a percentage basis, it probably won't rise as much, but it will hold its value better. And because you have more time, you want something that's going to hold its value. On the shorter term, we like these Delta 20 to Delta 50 calls. This is one of my favorite ways to grow an account, just because they're cheap. You can buy those things for like $1, and you got to get it right though. You can't do it on the wrong stocks or your dollars will go away. But you can buy these for like $1 to $3, okay? And they're super cheap. And with that quick price pop and IV pop, you can easily get a double on these. So that's the main goal there. And then where do you want to purchase them? You always want to purchase them in the same weekly series as the earnings date. This is very critical. This should have like 5 stars right here. Yes, the trades are always over before the announcement. Yes, because you know what is going to happen if you hold them through the announcement? They're going to be crushed. Yes, IBD. Yes, you will. Yeah. So, the people who aren't really aware of what's going on with this whole IV crush, they're coming in and they're buying these options directly before an earnings report. And unless the stock moves like 20% overnight, that it's going to be worth less the next day. Yes, it can happen. They can have a huge move overnight and it'll still have value the next day. But in my experience, every time I've ever held one of these through the earnings report, it's crushed. So we're buying it before and then selling it before the earnings report. You always want to buy it in the earnings series because those are the ones that are going to be impacted the most by the rise in IV. All right, just reading through the questions real quick. So the increase in IV pushes up the value of the option as the price increases. Yes, that's correct. And the crush after earnings will pull it back down. Yes. Let me check on the download for the slides. Mandy, are we doing a download somehow for the slides, or? That is a good question for Mandy. All right. Danielle, there are some exceptions. The Starbucks calls are around 60 cents. What delta were those? I think the ones I bought were a little bit more expensive than that. It just kind of depends. You just got to go through the options. All right, let me go through some of the examples, and then Henry is going to go to the live charts. But I'm going to go ahead and finish up the presentation, and then Henry will look at the live charts. Oh, the Delta 60. Yeah, Delta 60s. It just depends. You got to look at the options chain, and you have to see where the volume is, where the open interest is, how much it costs, how far out you are. All right. So, for example, this is a pretty good example of why you don't hold your calls through earnings. So here's an earnings report right there. Oracle is one of my favorites to do for the run into earnings. It typically gets a shorter dated run into earnings. So you want to look at this and you say, okay, well, where do I get in? Like we talked about, you look for a squeeze. In this instance, we didn't have a daily squeeze, might have had a lower time frame squeeze, not sure. Can't see it on this example right here, but what did I have? I had a perfect pullback directly to my Fibonacci level that overlapped with a 50-period simple that was in the time frame of about 14 days before earnings. So what you want to do is you want to time it with the pullback. So for looking, when you guys ask me, hey, is it too late? Whenever I get a question, is it too late to get into this? The very, very first thing that we want you to do is we want you to go to your daily chart and tell me where is price in relation to the moving averages. If your price is near the 21, the 34 EMA, even down to the 50, the answer is no, it's not too late. Okay. If the price is up here, do you see how price is up here and your moving averages are all the way down here? That is too late. Too late. Okay. Anywhere in here is not too late. Why? Because you're right up near support. This, too late. So any chart you just got to go to and check that out. Look for your areas of support, moving averages. If you don't have Fibonacci or Voodoo, just at least use the moving averages. You want to look for those pullbacks and get in when you have an edge. So buying something like this for Oracle, trade it higher, trade it higher, trade it higher, trade it higher. You can see the earnings report, boom, it just gets crushed. But you don't care because you sell it before earnings, right? That's the goal here. Another reason why we don't hold it through that earnings report. Just looking for the run into earnings. So here are some examples. Let me see. So the Delta 50s, I mean, they're pretty cheap, right? So they're pretty cheap, and you can look at the different deltas and see what the actual trade prices are versus what they're worth. So if you buy something for $1.10 and then it's $1.90, I mean, it's a good trade. It's a cheap trade, nice, easy trade for the most part. Here is Micron. Henry's super good at trading Micron for the run into earnings. This one in particular, he identified a 130-minute squeeze before the earnings report. So he had a solid trend on the chart. He had the earnings report. He had a squeeze, low IV with sufficient time before earnings, entry with an edge on a pullback to support. strong techie name, very bullish power gauge ranking with Chaikin. I don't think Micron still has it, but at this time when we were doing these trades last year, it did. So that was a really solid one. Here's a screenshot back from last year where we went into Chaikin and said, okay, well, what does Chaikin think about Micron? Very bullish, electronics, semiconductor industry at that time. The industry was really strong. So that fit our criteria. Why use the 130-minute instead of 1 hour or 4 hour? It doesn't really, I hate to say it doesn't matter, but we're just looking for a setup. So it could be on any of the time frames. You just have to trade the time frame that you find it on. If you have a 1 hour squeeze, then it needs to be within like a week before earnings. But the 130-minute squeeze will last a little bit longer, so it can be like a week and a half or so before earnings. So it's not, you just have to look for a setup and find it on that time frame and trade that time frame. Does that make sense? I know it's probably not explaining that in the best way. But what we're doing is we're looking across multiple time frames. Yes, always use the ready and fire, yes. So here is CMLVIS, comes in here and it tells us 14 days in advance. That's the best time to get into Micron, and that is what helps us time our run into earnings. And, I have a couple more examples here, but I'm just going to go ahead and I know you guys want to go and look at some live examples. So I think we got pretty much the overall idea down. Henry, are you about ready to switch on your screen share? I can answer a couple more questions. Another question maybe. I always love the ready and fire. Does the historic volatility matter? Yeah, yes, that's definitely another thing that you can look at. I am not sure about the recording for open house. Mandy will have to answer that one. Nah, he's here. Okay, I'm going to go ahead and kill my screen share. Henry is going to turn on his screen share and he's going to walk through some live examples. Yeah? Can I briefly explain how I use the ready, aim, fire? Really, it's really just a combination of the squeeze plus the ready, aim, fire. Honestly, I wish I could explain it quickly, but it's a little bit more.
Excellent. Thanks, Danielle. And thank you guys for joining us for a little bit more of this afternoon. I I hope you've been finding it helpful. As I review this type of work, I am reminded of the stages that I went through in working to learn and, of course, try to perfect these strategies. And it kind of comes back to the foundation of what Danielle showed in that presentation, which is to say, from a fundamental, just kind of like, what are you trying to do? Well, buying the implied volatility into earnings, I think is a very helpful concept. It helps you realize that there's a lot more to what we're trying to do than just the X and Y axis, right? If you're just trying to trade stocks or just trade futures, then it's all pretty straight up. It's either up or down and you make or lose money, whether or not you got the direction right is basically the long and short of it. When you start getting into options, well, then of course there's the other variables of your Greeks. And once you start to take those into consideration, especially implied volatility, it can really kind of open the door for you. So that's what I'm going to try to elaborate on for some of these examples that we've got that are coming up. I've got 3 or 4 that I wanted to review for the current market situation. And then if you guys have some other stuff that you'd like to browse through, we'll see how many other examples we can come up with. And I will show you a couple of ways that I try to make the best use of this software. So David, you say, what are your dots on the chart? Is that the parabolic SAR? That's exactly what that is. And I will also show you how I use that. Just to double check, I know the open house room is good, but do you guys have audio in the other room as well? I hate to get into all of this and realize I was only talking to half of the people here. Okay, excellent. Thank you, Frank. That is all I needed. and then we can kind of get into some of these ideas. So a couple of the things that I'm going to show you as I look at Microsoft, because this is one of the trade ideas that as I get into tomorrow, I've got to sit here and consider for myself, is this something that I'm going to be trying to pick up? Because you've got a squeeze and play, and Microsoft has been one of the more reliable names for looking for a run into earnings. Now, what I have found to be so helpful with the addition of this other software, let me do one thing here real quick. Going to remove this and then just add in the basic implied volatility. Because to look at this idea and say, like, all right, you've got a concept, you're wanting to buy this implied volatility as you move into earnings, that all seems pretty straightforward. And if you've ever worked with concepts like that, it doesn't seem too far-fetched. Now, of course, the whole kicker is, when are the best times to do this? And how can you try to narrow down situations that it may not be as effective? And some of what I've been going back and forth with right here, we'll come back into these charts. And these are some examples I'm going to show you. And then we can, drill down into some of the more, um, more nuanced aspects of this software. So what I've done here is we've got 3 different tabs, and I'll review each of these for each name. But you can see this 1, 2, and 3. Each of these tabs is going to relate to Microsoft, and they're going to be using the exact same strategy. So as this page refreshes, what's different about this tab versus the other 2? Well, the tab here on the far left-hand side is going back 10 years in time, and you can see that right here. So this is where you're seeing, okay, this is analyzing data from January 16th of 2009 to January 14th of 2019. So that's how far back in time we go. If you initiate this strategy when Microsoft is trading, and this is also the technical part of this, which they have added this to this software since I've been using it, but you can see it right there highlighted in the middle of your screen, where this is showing you that the only technical requirement that this has to meet is that the Microsoft shares are trading above the 50-day moving average. If you've got that, the idea of buying your position, about 2 weeks prior to the report, you can come in and look at custom earnings. This is where you try to finesse the timing. So you ask, okay, for like every name, are you going to want to buy it 2 weeks before the report? Or do you want to buy it, 1 day before the report? Where's the sweet spot? And this is what helps you kind of nail that down. Now, for this example, I'm just using 14 days because when I tell people, try to, how I would try to learn or finesse the strategy, I think somewhere between 2 to 3 weeks is the sweet spot. If you're trying to do it like, and I should label that as a week, just so you know that that's 2 to 3 weeks. But if you're trying to do it 2 or 3 days prior to the report, there's a pretty good chance that the implied volatility has already risen to a point that it's too expensive to buy. So I like to come in and you can alter these number of days. So that's one way to get a feel for how far out in time should I be trying to buy this. Now, and we'll get into all of this and how you can get into it, etc. But this is the type of stuff we talk about throughout the day. This is the way that I try to bring trades to people with this type of back data behind me. And that's one way to think about when to buy the implied volatility. The other thing that you can consider is this IV rank. And Danielle spoke to this briefly when she was covering that presentation, but up here in the top left-hand corner, you can see the IV percentile sits at, let's call it 47%. And what that is telling you is Microsoft's implied volatility in relationship to the implied volatility that it's had for the past 52 weeks. Because what you don't want to get into is buying when implied volatility is up here. That is telling you that the options are probably already about as expensive as they're going to get. So there's no real edge in that. Notice that if you look at, all right, what is this spike from? You can see I highlighted the upper part of the range and it has a very distinct, clear spike. Where did that spike in implied volatility come from? Well, it came directly from earnings. So you can see that the day before the report came out, implied volatility was the highest it's been in the past year. At that point, this reading would have been at 100% because it's as high as it's been in the past 52 weeks. Then as soon as the announcement comes out, the implied volatility gets hammered. That's also why you want to think about these trades in 3 stages. You want to think about the run into the report. You want to think about, am I going to do anything for the actual report itself? And then the potential of a trade after the report comes out. And we'll look at strategies around all of those. But this is just that third kind of thinking past the X and Y axis and thinking, all right, there's this other variable of implied volatility that is really going to impact the price of these options. I want to try and be long volatility into the report, get out of all of that before the news actually hits, and then we decide if you want to do something with it for the report itself. So what I'm trying to show you here is that the last time IV was as high as it's been was driven behind earnings. If you look at it to see where implied volatility is trading now, what you would say is that this is your high water mark. That's as high as it's been in the past 52 weeks. Somewhere right down in here is the 52-week low. So where we currently sit is 47% of that range. And that just helps you. And like I said, you can look at this off of just the implied volatility, and you can see how I'm trying to break it into thirds. Or you can use this little chart label, which is pretty much available anywhere. This is not a proprietary thing. That's something that's available in TOS. It's just nice to have on your chart so you're not always having to look into the options chain for it. But that just tells you that it's not too high to be considering buying the implied volatility. Okay, so now that we've got some background on a couple of things you can look at and why you might, is it too expensive? Not yet. And coming back to these, the results that you see here, this technical aspect of this trade could very well trigger tomorrow. And that's what makes, the timing of this kind of interesting. I didn't know that Microsoft was going to be right at that level, but, the conditions for this trigger, and these are all based off calendar days. I saw that come across too. So if you're looking at Microsoft off of calendar days and considering that you're basing this pricing information off of the daily close, which is how I like trading anyway. I like, kind of see the day through, whatever it may bring. And anyway, that's just kind of the way I like to do it. But if Microsoft is going to report on the 30th after the close, well, then tomorrow after the close would be the perfect time to evaluate this decision. So if you look at this and you say, all right, tomorrow Microsoft closes above 105.20. Remember that if you see these levels and you're confused about where I'm getting the values from, just remember that they all print over here on the right-hand side of the screen. So yeah, I do have a lot of them, but that's also why I try to use different colors so I know what I'm referencing in each spot. So if Microsoft closes above 105.20 tomorrow, that will trigger the conditions that we have seen in this trade. Now, getting back to the three tabs that I discussed with you, this first tab is going way back in time. And I feel, 10 years is quite a lot of data, especially for something like this. It's probably acceptable in Microsoft because it's been around forever. With some stocks, you're not going to have the leisure or the luxury of running that much back data. But then if you drop down into smaller time frames, and what I feel I'm trying to find in this is the most recent trend. So saying, okay, over the past 28 instances of this, it's won 20 times and lost 8. That's still pretty good. But as you drop down into these other tabs, I've just shortened the amount of data that you're looking back at. So if you look at Microsoft from, I'll show you this again, just remember this is where I always try letting you know where I'm referencing these values from. So when we look at a fresh chart, you'll know what I'm saying. But that just shows you that this has now gone from 10 years of back data to only having 3 years. And what does that show us? Using the more limited set of data, well, it shows us that the most recent bull market of the past 3 years has been extremely beneficial to Microsoft. So instead of having kind of, 20 wins and 8 losses, well, now you can see that this strategy wins 8 times and has only lost once over the course of the past 3 years. Then you drop down to and you can do this. That's what's so cool about this too, is you can customize it to whatever you want to look at. I feel like for most of what I've done with this, we're getting enough back data. So in this case, this is using an even shorter look back period of just the past year. And you can see that this offers 3 wins and no losses. Now, you guys know that I'm not going to come in and tell you this strategy is going to work. But when you look at the data, you can see kind of how I feel like the progressive nature and maybe just the fact that the market has been so bullish, Microsoft has been a direct beneficiary of that. So the idea is that tomorrow, if we get that close, we're coming in, and you can tweak this a lot of different ways, but the way this back data is presented, that you're using the options that have 30 days till expiration, which will still see an increase in implied volatility, maybe not as sharp as the series that revolves directly around the report, but that's another thing you can customize. But it's just the idea that if you close above that moving average, well, then you are picking up the long Microsoft Delta 40 calls. This shows you the strategy that is being discussed here. Right there, we've got the 40 delta calls, how much life is left in them, and then the parameters that you use around them. This is another thing that I have found to be so helpful with the addition of this software, and maybe a way that some of you think already. When I began my trading, and as I've progressed with this over the years, I've always felt like, if I'm buying something, I'm going to look for my technical target. I want to see it come into that 1272 extension. I want to see it come into my snow line, whatever it may be. And you kind of let the money take care of itself. That's a way of technically finding your targets. This type of work really opens you up to a very smart way of thinking, which just says, I don't care what it looks like technically, I care about the percentage gain inside of it. And once you start thinking that way, you're saying, all right, if I pick this up for a given debit, then I already have my limit order out there getting ready to sell it. And I think that's the best way of trying to take advantage of those situations. So as far as I've got the volume, it should be pretty much cranked, Jim. Hopefully it's coming through okay. That's the last question I saw here. And then, yep, IBD, like I said, a lot of different ways to use this data, but I'm just showing you what I think is interesting, where you can go back and reference so much in a name like Microsoft and see how it has generally been, I would say, more progressive in the most recent years. I think that's just a interesting metric to look at. And then you say, could you check the Delta 40 put? Well, we definitely could look at that, but I feel like, it's just going to be basically the opposite. Let me get through a few more of these examples, and I'll throw a couple in here that you guys would like to look at. And then would you use a 30-day option? Now, I tend to use the little bit shorter dated options because I prefer to get that bigger kick in the implied volatility. Like if we pull up a chain of Microsoft right here, we can see, pretty sharp where the implied volatility makes its biggest jump, because this week we're sitting on 25%, next week is 25%, and then we have this jump into 32. So I tend to try and focus on this series that is the shortest dated expiration that will still benefit from the rise in implied volatility. As I've worked with Ophir and this type of stuff, and he's kind of shared the way he looks at it. He is not against, and that's why a lot of these that, and I've got a couple more things to tell you guys about before we break today, but he'll buy some of these that are out here. You notice how there's not that much difference. Now, when we get up and we're right against the day of earnings, this series should be a little bit sharper. You should see more of a reflection of that IV here than you will back here. However, both of them will still benefit. This series out here, not so much, right? I'm not telling you, we would never do something out here in 2020 or 2021, but can you use the 30-day or maybe the 17? Sure, both of those will share some comparable ideas. But those are the two things to focus on, or just at least to remember, is that this series will have less theta decay, meaning it will hold on to its time premium better, simply because there is more time in them. And then this series will have a sharper reaction to the implied volatility. So I tend to focus here. Any of these right in here would be just fine. And that's how I would answer that question. And then will these third-party tools work on E-Trade? Well, the thing to remember is that this is 100% web-based. So it isn't anything, it doesn't tie into Thinkorswim, it doesn't tie into any brokerage per se. And I'm just showing you the chart, or the chains and chart that I'm using in Thinkorswim, and then the browser window that I'm getting all of this external data from. Like I said, this is, the software is an addition to what the room would be and all of that, but this is just hopefully to kind of for me, when I saw this the first time, it really seemed kind of like an eye-opening thing, because I knew what I was trying to do with the rise in implied volatility, but now I had a very unbiased way of calculating that. Instead of saying like, hey, Microsoft tends to treat me well for these types of runs, I could really quantify it, and that makes my brain happy. So looking at a couple of these other examples, I think you know what the plan is for Microsoft. We'll get to discuss that a lot more tomorrow as we get into the close of the cash session. A couple of these other names that are worth looking at and running them in exactly the same way. Like I said, I figured we'd just take a quick look at these three, and then we could discuss whatever else you guys would look at, maybe look at some of the other features of this software. But now we're going to look at these three tabs, all of which are doing exactly the same thing, but now we're coming back and looking at Google. So in Google, kind of a similar situation, just these types of tech names that, especially over the course of the past couple of years, have really seen some enthusiasm, excitement, whatever you'd like to call it, into their earnings report. So here we've applied the exact same type of technical trigger, which is to say the Google share price needs to have a daily close above the 50 simple moving average. So when we come back and look at Google today, what did it do today? Today is, it's been a little back and forth. Like I've said, interesting to be doing with this with you guys today because so many of these have started to meet these technical requirements. So yeah, yesterday it was below it, but look at this level of symmetry. What I'm trying to do when I offer symmetry, I think it is best seen by hiding your studies. So you're just looking at clean price action and you're trying to make the argument that this is the overall bullish trend. It doesn't have to be a perfect channel, but if you can kind of see that in your mind's eye, okay, that's the basic path of least resistance. Then inside of that, I am looking for declines that match previous declines. And look at how that low yesterday came right into that symmetrical area. So you've held symmetry, then you come back in and apply your studies again to see that today we did close back up above that 50 SMA, and then we're just basically facing a very similar situation. Now, Google earnings are a little bit further out. So if you're going to try to treat this as the exact same technical signal, well, then you would try to focus on buying it on the 21st, right? Because the 21st would be that 2 weeks prior to the report. You could come back in and say, all right, well, if it does well on 14 days, what does it look like if I do it 21 days? You can, kind of work that as you see fit, but it's just another example of showing you the same thing, where if we're going back here again using 10 years of data, you can see that you've got 15 wins and 5 losses. If you narrow this down to look at more of the immediate data, where we're referencing only 3 years, well, then you've got 8 wins with only 1 loss. And then the last instance where we're only referencing a shorter period of data, here it shows 2 wins and no losses. Now, why does it not show a third interest or a third instance if we're running it with a year's worth of data? Well, because there would have been a series omitted when Google was below the 50 SMA. So it's just trying to use a little bit more of a technical backing to confirm what you're looking at in the implied volatility anyway, and that just, it would help filter out a loss that, presumably a loss that would come from trying to buy that out of the money call when the stock is a little bit more bearish. So that's another one of those that, we'll look and I will dive into it a little bit more and see how it looks buying it maybe a little bit ahead of time. I will also tell you that as helpful as I have found this data, I would also say it is very helpful when you have a good technical confirmation, right? I feel like there's kind of 2 groups of traders maybe, where one group is very technical and really enjoys diving into charts. And then there's another group that'll say, I'll never look at a chart and I strictly trade off of information like this and, working the Greeks and that sort of thing. The sweet spot is where you combine both of them. So that's to say, if Google had squeezes, which look at this, the daily squeeze, and I've commented on it, the daily squeeze to me has been a little bit awkward because it did technically fire long, but the price action inside of it has been a little back and forth. But if you're sitting here thinking, man, Google strikes me as a little bit extended, well, then I feel like you're ignoring all of this right here. So if you look at a 2, a 3, and a 4-day squeeze, which is shown in that multi-squeeze indicator, I like keeping that in the back of my mind, and then I will flip over to this chart because this just offers a very different perspective. And on something like this, you can see, oh, wow, that's a big squeeze that has been coiled for some time, and that could very well continue to propel us into higher prices. So that's the way I'm looking at Google. I think the idea of, the technical close above the 50, the confluence of that with these various squeezes can provide some really helpful technical information. So that's what I've got there in Google. And then you ask, you would need to change the days of expiration to get the true results for the trade in the CML tool. Well, that's correct, Anaya, if you did it in the shorter dated options. What I'm showing you right here is good, valid data for the 30-day. And also, I feel like the 30-day is it's less aggressive, because if you're going out further in time, yeah, you're going to pay a little bit more for the option, but you're not right up against the wire as far as the time decay goes. So once again, I'm just showing you all of the different ways to look at this, how it's what I think is the most helpful instances of it. And then if you want to adjust the series that you're buying or whatever it may be, then yeah, take those variables into consideration. And then we can say that 1 month before earnings is a safe way to catch the long setups or to catch long trades with the right setups. That's the general idea, Francisco. Like I said, here again, I feel like a month is maybe a little bit too far out, the metric that I've given. And I encourage everybody, take the stuff that I'm sharing with you, take the parts of it that make the most sense, and then do what you will with the rest. But I feel like 2 to 3 weeks is the sweet spot. If you want to try and push it and do a month, I suppose you can, but the fine line, what you're really trying to do here is capture, like where maybe if we go back to this Microsoft chart, it'll be a good one to show you. You're really trying to capture is this move right here. In those slides that Danielle presented, she had them kind of boxed off, showing something kind of like this. This is the moment in time that you're wanting to capture. So if you're buying your option right here, well, then it's sitting there not doing anything, right, for a long run of time. And that's when the time decay will eat against you. But if you can buy it right when that IV really starts to pop, that's what you're trying to finesse. And like I've said, I was doing this back when I was just looking at this IV and its relationship to itself. With this other type of back data, I've been able to get, you can get your timing a little bit better. Happy brain, happy Henry. That is a great way of thinking. And could you show a real-time option chain showing where you would get into Google based on your setup? You bet. So if that's what we're going to do, and you can do it in Microsoft or in Google. I'll wind up these examples here pretty quick. That way I can get more down into questions that you guys would like to look at. But if you're going off of the data that we have just discussed here, which is to say, all right, tomorrow, Google closes above the 50-day moving average, which option do you come in and pick up? Well, then you'd be looking at, and it would be right on the day, right? Because tomorrow, the 31 days will be down to 30. So you'd come back in and look at buying the Delta 40 option. Now, I don't have a Delta 40, so which one of them do I go with? And of course, tomorrow this may vary. Maybe I do have a Delta 40 depending on exactly how it's trading. But since I only have strikes that are listed $5 wide, I don't have as much granularity where if I had dollar wide. Because if I had dollar wide, I could pick pretty much whatever delta I wanted. Okay, you don't. So what do you do with that? That's when you have to ask yourself, do you want a little bit more direction or do you want a little bit more exposure to the implied volatility? At the end of the day, I generally prefer buying those that have a little bit more intrinsic value. The Delta 50s will still have a nice reaction to the implied volatility if you can get it right. The Delta 30s are going to need a little stronger move. So once again, the back test and the data we've shown is all using a Delta 40. If I find myself in a spot where I have to pick or choose between the two, I'm probably going to pick this one for the reasons discussed. Now, also, it is not a bad idea to do both. And some of these, I remember I've had some good trades in Microsoft and Micron do come to mind in situations where you're kind of layering them, which is to say, all right, I've got $3,000 I can put at risk. I'm going to put 1,000 here, 1,000 here, and I don't know, I wouldn't do the Delta 10s. It's a little outside of what I want to do, but you can see the idea. And then you've got some exposure. So if it explodes higher, well, then both of them will do very well. If it just kind of chops and maybe gently moves higher, well, then that Delta 50 is going to do a better job of holding its intrinsic value than the Delta 30 will. So that's how I would take what we're looking at and really put it to work for tomorrow's session. And of course, the beauty of that is that I'll be getting to do the close with you guys tomorrow. So depending on where these close, I'll be happy to look at them with you. One last thing, and then we'll get down into that PayPal example, is that if you did this with Microsoft, I would still very much encourage you to risk the debit paid. So you're not sweating it. You acknowledge that there is no stop in this position. The stop is the risk that you've got on because that's the beauty of options. It can't go further against you than that. So that's the first thing to consider. The second to consider is that if I'm buying those out of the money options like that, even though the CML tool suggests it as being a good, back-tested, kind of reliable strategy, I'm still going to ask myself, how do I feel if this thing pulls back into the 21 EMA? And I acknowledge it, I embrace that before I ever even put on the trade. That's something where I feel like when you're a beginning trader, you feel like, all right, perfect. I've got my technical trigger, I've got my squeeze, everything looks great, max risk up here, let's get it. And then the very next day, it's down $3. And you're sitting here thinking, what am I doing with my life? Instead, the more appropriate way is to say, let me think of this in thirds. I'm going to take the third on the technical trigger that they're suggesting. I'm going to leave the other 2/3 to evaluate if I'm back down here at the 21. This also goes back to how I'm not going to take a stop if this thing falls $2 or $3. Now, if it's down like 6 or 7, the trade isn't going to work and we may have to reevaluate. But just remember, a little bit of weakness down into the 21 EMA should always be accepted, acknowledged, and you should be happy with that. It's not to tell you that if this triggers conditionally that we have just bought the low. So keep that in mind as you work through this. Another example I wanted to share with you is coming here into PayPal. And this is an example. I tried to pick some of these that not only have good back-tested data based off of just the pure options themselves, but to pick some that also show good technical signals. So just like when we looked at Google and I showed you those, the confluence of all the squeezes we've got going, notice how you have exactly the same thing here in PayPal. And it actually looks like the 2-day may have already fired. So do you see how here again, 1-day squeeze fires long, and that kind of starts the move. Now PayPal may be a little bit tricky because you start piling into it up here around 92, that you have to be happy with it back at 87. And that pullback is not going to be for the faint of heart. But this one is interesting because the lifetime highs are only a stone's throw away. So if you're a shareholder and you've been able to weather all this chop, it's just speaking from my experience, I'm not going to bail on my shares. I don't have any right now, but if I did, you're going to be looking for that new high. So that's one thing that I think could be beneficial in this. And then if we come back and look at that 2-day squeeze, that 2-day squeeze has fired as perfect as you could have possibly asked for. And then what you're looking for is a cascade into the other time frames. So you can see what the 2-day has done. That should lead into the 3, 4-day, and weekly. And then the targets you set up are just a very basic 1272 extension off of that major swing high against a major swing low. And I think PayPal has every shot at being a $100 stock. The extension is 98.88, but among friends, we can call it $100. And that's just another spot of saying, I think this trade has a good probability of working out based off the past testing of it. Same thing where if you narrow down into more recent examples and using those technical triggers, it's got a good backing. So here again, the 3 that I've shown you in these examples all have the stock trading above the 50 SMA. Obviously, PayPal is way above that. It has been for some time. There's no excuse to be made other than it just wasn't something I was looking at that exact moment. But do you see how if you're using that kind of back data and you're looking at the squeeze right here and you're looking at the close above the 50 SMA, do you see how you can use that as a reason to get in, even though you may not be sitting perfectly on top of the 2-week metric? That's why I give you kind of a wide window and say anywhere between 2 or 3 weeks, at least consider it. Because if the chart looks really good, or it's like at a prime spot to execute on, I don't want you to be holding off on it because you're saying, well, I got to wait for 2 weeks. As we get into tomorrow will be right at the 2-week mark. So this analysis still applies, but this is a good example to show you, various spots where you could enter those. And then what level of membership would you recommend for a person who may be in the room 2 times a week for a couple of hours? Well, and I think Mandy answered that in the fact that the gold is kind of it's the one you would look for. Obviously, I'm a little bit biased as, we all kind of put a lot into this, but I would tell you to give it a shot. I think even if you are only able to join 2 days out of the week, you would still find the mobile app to be helpful. I use it when I'm driving into work because I can listen to Raghi earlier in the morning. This, of course, depends on what all you've got subscribed to, but I find it helpful in a lot of different ways. And then if you find that it's not helpful, there's no obligation to it. And then is CMLV is used when stocks are presenting earnings, or is it more of an analytical tool? I would say both. The other thing about this, Andy, is that when you look at this software, everything that we've been discussing revolves custom earnings, right? Which is incredibly helpful because you can narrow down, all right, this is the moment I want to open it. This is the moment that I want to close it. You can disregard earnings entirely and say, for my earnings handling, sounds like an animal, but for my earnings handling, don't do anything special, which is to say, If you're looking at a particular strategy, it just depends. Like it ignores earnings. If you'd like to look at it and say, I never want to be involved with an earnings trade, well, then it's going to give you, different results. So, and do you see how, that's as you ask that question, and as I just toggled that one little feature, look at how much worse the results are, right? And I think this really drives home a very important concept, because if you're just using this as a basic everyday in and out type strategy, buying Delta 40 calls is not a winning strategy. But when you customize that to say, I want to do it at a very specific moment in time, well, then that changes everything. And that's the whole kicker to what we've been discussing here this afternoon. And then how about buying a call butterfly? I would never do that because you don't want to be on the wrong side of the implied volatility. Now, if you wanted to do a call butterfly on the day of the report, then that's an entirely different discussion. And that is a strategy I enjoy at that point. And then, let's see. And then when the heat was on, we were watching Google Gap on 427.17. Is that off the table, or will we revisit it in the future? I'd have to come back and look at that, Tony. As the question hits me right now, I don't know that anything that I would look at from 2017 would be relevant to what we're looking at here. But let me know if there's a different question you're looking at in that. And then, can this run into earnings be done with a vertical debit spread? I would not encourage that. Because here again, remember, think about what we're doing. Everything we've been talking about here is like buying the Delta 40s or, various deltas. But and the thing that's tricky about this 379 JC is that it could work. But are you really maximizing the strategy to the best of your ability? What you get into is that if you buy, the in the money option, and then you're selling the out of the money option, remember that you could really see that implied volatility really increase in the out of the money. The reason why I mentioned to Andy just a moment ago that I wouldn't do the butterfly is because if you get right up to the body and say that price is sitting right at that out of the money strike, that is going to be the most juicy option of all of them. The most extrinsic value is going to be found in these out of the money options, or right there at the money, and you just sold two of them, right, with the butterfly. So, what you're really counting on is that whatever strike you chose here is deep enough in the money to make up for that. But if you're doing these really small and the contract that you're short two of them has really expanded, you're not going to be in good shape. So it's just one of those things where it could work, but if you understand why we're trying to do it the way we are, I think you'll probably prefer just buying those options. And then, is there any instance when you would hold your position through earnings? Yes, there are situations where I would do that. Like, I've considered it with PayPal. I've also considered it with Starbucks, because both of these I think have merit, right? In PayPal, we discussed that big extension. So if you can give it enough time, I think you have a chance of getting up into it. Also with Starbucks, I like this because, the last earnings gave an excellent move, which I think will help drive some anxiety or some implied volatility into the current series that we're discussing. And I keep looking for this fire line overhead at 74. So for certain situations, you may consider it. As a general rule, I would tell you not to. I would tell you to track your trades in three ways. That is the run into the report itself, and then whether or not you want to do something afterwards. And if you can divide them in those three ways, I think it makes for a much more clear understanding of which ones you like and which ones may not resonate with you as much. I will also say that there are times where I have to hold through earnings if you're focused on things like the elephant trade setups, which were one of the ones that John taught a long time ago that I still really enjoy. But for those elephant trade type setups where you're trying to buy further out of the money options and capitalize on these moves, well, then there may be points where you've got to hold through that. So, not, I wish trading was all just black and white answers. I would give them to you, but, sometimes there will be some of these variables, and hopefully that's a helpful way of considering it. And then, would you buy $100 butterfly for PayPal? I don't think that's a bad trade at all, Eric. Now, the trick is when do you put it on? Because here again, if you put this on in the series, like say you put it in these 31-day options, well then as PayPal moves into the earnings report, it may go against you a little bit, but to have that would be a trade that I would hold through the report, because, once the report is over and done with, the implied volatility is going to fall out of it, and then you're just left with what your, whatever the spread is worth. So for something like that, yeah, that'd be just fine. Just remember that with that butterfly and those two short contracts, you're short volatility in those spots. And since we're assuming IV is going to rise, the timing of that is kind of important. And then, yeah, on selecting the best time, George, like I said, hopefully the discussion that we've already had on that has been helpful. I've shown you the 14-day out, which is the discussion we've had on a lot of these. And then if you look at it and say, well, okay, that's the assessment for the 14-day out. What would it look like if I did it 21 days out? And that allows you to kind of sit here and tinker with it and find the perfect spot. Like you can see in PayPal, going out 21 days is not as successful as if you do it 14 days. So I've shared a lot of different ways of thinking on that one, and then using the software, you can drill down into whatever particular name you're using, and whatever you think on it. And no, I'm with you guys, talking about how PayPal is a little extended, but it's strong. I mean, sometimes I feel like I'm stuck in the matrix or it's some type of a paradox because like John would buy this stuff and I swear it would just keep going higher. Then the moment I touch it, it has to pull back. And that's why at the end of the day, the best advice I can give you is stick to your plan. Because if it's in your plan to say, all right, I'm going to allow for this and that, or, for these reasons I'm buying it, well, then you're sticking to a set of rules. And trades always work out better when that's the case. I hear you, Gary. And like I've said, it really comes back down to kind of a weird paradox, but I would just find that when I'm following my plan, then it would tend to work out a little bit better. I feel like PayPal is destined to make these new highs. If by some chance I'm wrong, and that's the other thing, you want to be in a position where, say, all right, you did accumulate some up in here, and then whatever happens, and we wake up and PayPal is trading down here, well, then you are excited about buying more. You're not sweating what has happened here. You already acknowledged the risk of that, but you've got some extra cash on the hand, right? That 2/3 or whatever it is that we discussed, and you're ready to execute the plan, not sit there and sweat it. But that is good stuff. Well, that takes us just a little bit past the bottom of the hour. I think that's, like I said, it's a pretty full review of the way you want to think about these reports, think about them for the 3 separate times or the 3 special instances that you can work on implied volatility, and how to think about them, tools to finesse the entries, and hopefully some good names that'll help you guys as we get into this next round of earnings. And then are you buying 30 days or those that expire 14? So here again, don't quote me on this, but I think you guys are getting the recording of this. If not, it'll be, it is available to members if you decide to sign up. But I spoke about that with some detail, Jim. All of the results that I've shown you here are using 30-day out options. If you want to do those that are shorter dated, they, the same way of thinking will definitely apply. It's just a little bit tighter. Like in PayPal, it might make sense to go out into the 30-day option so you can weather that pullback a little bit better. But that's what we've got there. And how about buying a straddle into earnings where both puts and calls increase? You can do that exact same type of back testing, Eric. For what I've shown you today, I wanted to keep it kind of basic because once again, over the past, let's call it 2.5 years, where you've seen just this incredible bull market, this is what has worked best. So, that's what I wanted to bring to you. If you would prefer to look at it and say, all right, instead of being long the calls, let's look at being long the straddle. How does that end up producing for us? And you can run the exact same type of test. So. All right, guys. Well, I think that pretty much covers everything that we were hoping to share with you. If you have any other questions, I will be in the chat room all day tomorrow. John is going to be kicking things off at the cash open. I will be in for the cash close and happy to answer any questions that I can for you during that time. So thank you again for being here. Have a great rest of your afternoon, and I hope to see you again tomorrow.